Hey everyone, welcome back to Corporate Decoder, where we take apart complex financial documents and tell you what they really mean. This time, we're diving deep into Commercial Metals Company's latest annual report, and let's just say it has got a few surprises, especially when it comes to their legal battles and big spending plans. Commercial Metals Company, or CMC as they're known, is a big player in the construction materials world. They make steel products used in everything from buildings to bridges, and they've been around for over 100 years. Think of them as a backbone for a lot of the infrastructure you see. They operate in three main areas: North America Steel Group, Emerging Businesses Group, and Europe Steel Group, and they're all about recycling metals and turning them into useful products. This is their annual report, kind of like a yearly deep dive into how the company is doing. They operate in the US and Central Europe, and they focus on providing essential reinforcement for construction projects. Now, the first thing to know with these reports is that companies talk about what they think will happen in the future. They use words like expects or anticipates. But, and this is a big but, lots of things can change that, so we always need to be a bit skeptical about those future predictions. Founded way back in 1915 as a small scrapyard, CMC has grown into a major solutions provider. They're all about building a stronger, safer, and more sustainable world by recycling and making steel products, with about 98% of their materials coming from recycled sources. That is pretty impressive for an industry often seen as polluting. They break down their business into three main parts: North America Steel Group, Emerging Businesses Group, and Europe Steel Group. This helps them track performance in different regions and markets. In North America, CMC has a full operation. They recycle scrap metal, melt it down in their steel mills, and then fabricate it into products like rebar. Their strategy is all about controlling costs, from getting scrap metal cheaply from their own recycling facilities to running efficient steel mills. They're even building a fourth micro mill in West Virginia, which is a huge investment. This segment is where they're innovating. They sell things like ground stabilization solutions, specialized steel for military vehicles, and even advanced reinforcing steel that resists corrosion and works in extreme temperatures. They are also involved in prefabricated bridge systems. This is where they're pushing the boundaries and looking for new growth. Over in Poland, they have a similar setup to North America with recycling mills and fabrication plants. This segment has been doing well recently, posting an 8% increase in net sales compared to the previous year, partly thanks to recovering construction and industrial activity there. One thing we see across the board in construction-related businesses is seasonality. Because construction ramps up in warmer months, CMC's sales are usually higher in their third and fourth quarters. It's just a natural cycle of the industry. The steel industry is tough with lots of local, national, and international players. CMC competes on service, quality, and price. They're a big deal in rebar manufacturing and fabrication in the US, and a major producer in Poland. They also face the challenge of global overcapacity, meaning there is more steel being made than needed, which can drive prices down. Their big advantage is being vertically integrated. They control the process from scrap recycling to finished products. This helps them manage costs and demand, especially when global markets get tricky. CMC really highlights their commitment to sustainability. Making steel from 98% recycled material is a big win for the environment. They talk about products like Rebazero, Merchant Zero, and Zero, which they say have net zero emissions. This is becoming increasingly important for investors and customers. Now, let's get to the juicy stuff. Every company faces risks, and CMC is no exception. First, the price of scrap metal and other inputs like electricity and gas can swing wildly. If raw material costs go up and they can't pass that on to customers, their profits suffer. This is a constant battle. They also mention labor shortages and the challenge of finding skilled workers. That is a problem many industries are facing today, pushing up wages and making it harder to operate at full speed. Then there is the big one, the legal battle with Pacific Steel Group, or PSGA jury found CMC liable for antitrust violations and awarded PSG a staggering $110 million. This amount was then tripled by law to over $362 million. CMC is appealing this decision, but it is a massive financial risk hanging over them. They reported over $362 million in litigation expense in 2025, just for this case. CMC also worries they might struggle against bigger competitors who have more money and lower costs. This is a common concern for many businesses. CMC is investing heavily in new micromills, including one under construction in West Virginia. Building and starting up new factories is always risky. They worry about delays, cost overruns, and whether these new mills will actually perform as well as expected. If they don't, those investments could be lost. Cybersecurity is a big concern for everyone, and CMC is no different. A data breach could damage their reputation, lead to lawsuits, and cost a lot of money. While they say they have measures in place, they admit that these threats are constantly evolving. Environmental, social, and governance issues, or ESG, are increasingly important. CMC acknowledges that focusing on these matters like reducing emissions and improving social practices could lead to more costs. They are also under more scrutiny from investors and the public on these fronts. Like many large companies, CMC has debt, and its loans come with rules called covenants. If they break these rules, it could cause big problems. CMC has growth plans that include buying other companies. They just announced plans to acquire Concrete Pipe and Precast LLC or CP&P for $675 million and Foley Products Company LLC for about $1.84 billion. That is a huge amount of money. They refunding these with cash and debt, and integrating new companies is always a gamble. If it doesn't work out, it could hurt their finances. When companies buy other businesses, they record something called goodwill. This is basically the premium they pay over the actual value of the assets. If the acquired business doesn't perform well, this goodwill can lose value and CMC has to take a big write-down, which hurts their profits. Let S peek at the financials. They are buying back their own stock, which can be a good sign if they think their stock is undervalued. They repurchased almost 1 million shares in just 3 months in 2025. Looking at the numbers, net sales in 2025 were about $7.8 billion, slightly down from 2024. But here is the kicker: net earnings plummeted by 83% to just $84.7 million. That is a massive drop. The main reason for this huge drop in profit, a massive litigation expense of $362 million related to that PSG lawsuit we talked about earlier. Without that, their net earnings would have been much higher. This shows how a single legal issue can dramatically impact a company's bottom line. In their North America Steel Group, net sales went down about 4%. Their profits, measured by adjusted EBITDA, dropped by 21%. This is mainly because the prices they could get for their steel products and downstream products didn't keep up with their costs. Think of it like this: they're remaking less money on each piece of steel they sell. The Emerging Businesses Group, their innovation arm, actually saw a 4% increase in net sales and a 6% increase in adjusted EBITDA. This is positive, showing that their newer products and solutions are gaining traction. The Europe Steel Group had a good year. Net sales were up 8% and their adjusted EBITDA jumped by a massive 208%. This was driven by higher sales volumes and better profit margins on their steel products, partly helped by government assistance programs for energy costs. Then there is corporate and other. This part of the business saw its adjusted EBITDA loss balloon to over $508 million, which is a huge jump from the previous year. The main culprit, that $362 million hit from the PSG litigation. Financially, CMC seems to have enough cash on hand, around $1 billion in cash and cash equivalents. They also have access to a $600 million revolving credit line, which is like a safety net for borrowing money if they need it. They expect to fund their upcoming big acquisitions with this cash and by borrowing more money. These upcoming acquisitions of CP&P and Foley are massive. They rebuying companies in the precast concrete business, totaling about $2.5 billion. This is a huge strategic move to expand their offerings, but it also means taking on more debt and integration challenges. They re-spending a lot on new facilities too. The fourth micromill in West Virginia is a big project, expected to cost between $550 and $600 million. They also getting some government assistance and tax credits for this, which helps. So, what is my take on Commercial Metals Company? On one hand, they are a well-established, vertically integrated company with a sustainable business model. Their Emerging Businesses Group and strong performance in Europe are definite bright spots. They are also making strategic moves with significant acquisitions to expand their footprint. However, the massive legal loss in the PSG case is a serious concern. While they are appealing, that $362 million expense significantly impacted their earnings. It highlights the critical importance of managing legal risks. Their reliance on commodity prices for scrap metal also means their profitability can be volatile. They are making smart moves into new product areas, but the scale of their debt financing for recent acquisitions means they will need strong execution to deliver the expected returns. In conclusion, CMC is navigating a complex market with both strong strategic initiatives and significant risks. The coming years will be critical in seeing how well they can integrate these new acquisitions and manage their legal challenges. What do you think about CMC's strategy, especially with those huge upcoming acquisitions and that massive legal hit? Let me know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate deep dives. And don't forget to join our Discord community, linked in the description for even more discussions. Thanks for watching, and I'll see you in the next episode of Corporate Decoder.